All right, let's just dive right into this massive slate of January 2026 policy updates from the RBI. If you follow the financial sector, you already know that keeping up with these regulatory shifts can literally feel like drinking from a fire hose. But as we're going to see today, this isn't just some random assortment of new rules. It's a carefully constructed, highly intentional approach to building economic resilience. We are going to unpack these updates, pulling directly from the RBI's latest bulletins, guidelines, and discussion papers, and explore exactly how the central bank is aggressively future-proofing India for what is becoming an incredibly unpredictable global landscape.
To make sense of this really dense regulatory environment, we've organized the updates into 5 core pillars. We're going to cover Pillar 1, navigating global economic risks, Pillar 2, tightening banking regulations, Pillar 3, priority sector lending updates, Pillar 4, protecting the digital consumer, and finally, Pillar 5, relief and state finances.
Before we get into the weeds, we absolutely have to start with this guiding philosophy from Governor Sanjay Malhotra. It perfectly sets the stage for everything we're about to talk about. In his address, he made it abundantly clear, through all the volatility, all the rapid technological changes, and all these complex policy shifts, financial stability remains the RBI's ultimate North Star. Literally, every single regulation we look at today traces directly back to this one core objective, absorbing economic shocks while still promoting responsible growth.
Okay, let's hit Pillar 1, navigating global economic risks. So despite a really firm domestic economy, one that's being supported by benign inflation and strong demand right now, the RBI is keeping a very close eye on persistent global risks. Because let's face it, 2026 is shaping up to be a highly uncertain year. It's being defined by shifting policies and ongoing geopolitical tensions. What's particularly concerning on a macro scale are these stretched valuations of risk assets combined with rising global public debt. Plus, there is this growing interconnectedness between traditional banks and non-bank financial intermediaries. That interconnectedness means a shock in one specific area can spread like wildfire through the entire global system.
And this right here perfectly illustrates why India is actually weathering that global storm so well. The latest January 2026 bulletin shows broad-based strengthening across the board. Net domestic financial wealth jumped up to 28.6% of GDP, while the financial resource balance deficit was slashed all the way down to just 0.9%. To put that into perspective, everyday households and financial corporations are basically acting as the entire economy's savings account. They're financing the deficits of both the government and non-financial corporations, which makes the domestic economy far, far more self-reliant.
90.03. So that is the rupee's closing rate per dollar on January 8th. And there's actually a fascinating story behind it. The rupee had fallen sharply by about 5% in 2025, but the RBI isn't just blindly defending some fixed line in the sand. Instead, they're executing this highly pragmatic forex intervention strategy. On this specific day, the rupee opened at 89.96. The RBI strategically intervened just to prevent a freefall, helping it hit an intraday high of 89.74 before it finally closed at 90.03. By allowing forward premium to rise to nearly 2.70%, they naturally encouraged exporters to sell dollars. It's just a masterclass in managing excess volatility while still letting the market determine the actual price discovery.
Moving right along to Pillar 2, tightening banking regulations.
Now, the RBI is proposing a hard cap, limiting commercial bank dividend payouts to exactly 75% of profit after tax. Think of it like this. They're essentially forcing banks to save for a rainy day rather than blowing their entire paycheck on shareholder payouts. Under these draft guidelines, banks' boards are now required to rigorously consider long-term growth plans and capital resilience before they remit any profits. It's a deeply proactive step to guarantee that paying out shareholders doesn't accidentally weaken the bank's fundamental ability to lend or weather a sudden economic storm. This same pragmatism totally applies to infrastructure too. We all know these projects require massive amounts of capital and have incredibly long gestation periods. Initially, the RBI had proposed a really strict rule demanding 100% project debt repayment before relaxing the risk weights for non-banking financial companies. But they actually listened to stakeholders and moderated it. Now, a 75% risk weight unlocks after just 20% repayment. The RBI rightly recognized that even a 20% repayment demonstrates a credible, real-world reduction in project risk. It beautifully balances the need for credit expansion with overall financial stability.
They've also gone in and cleaned up related party lending rules to prevent dangerous conflicts of interest. The old framework was, well, let's just say a bit ambiguous. The new 2026 rules bring some much-needed clarity. They've replaced that vague term senior officer with specified employees, which is now defined strictly as those up to 2 levels below the board. They also completely eliminated the old 5 crore shareholding threshold. But here's the smart part.
To prevent massive market disruption, any existing non-compliant loans are just allowed to naturally run their course to maturity, as long as they aren't renewed or enhanced.
Now this is really cool. The RBI's push for digital, AI-driven supervision is actively paying dividends. To measure the accuracy, completeness, and timeliness of bank data, they introduced the Supervisory Data Quality Index, or SDQI. Just look at the jump between June and September 2025. Literally every category of scheduled commercial bank improved. In the RBI's eyes, a score above 90 is good. It is genuinely impressive to see both public sector banks and small finance banks securely crossing that 90-point threshold. It's solid proof that moving towards near real-time soup tech is fundamentally upgrading the integrity of the whole system.
Talk about a comeback story. Back in 2004, the RBI put a complete halt on licensing for urban cooperative banks because of some pretty severe governance failures and financial stress. Now, after more than 20 years of evolving regulations and operational pruning, the RBI has finally released a discussion paper to resume licensing. But make no mistake, the bar is incredibly high now. New applicants have to hit a massive 300 crore minimum capital requirement, show a pristine 10-year active track record, maintain a capital adequacy ratio of at least 12%, and keep net NPAs below 3%. Plus, they're heavily favoring entities with a multi-state footprint to ensure they have diversified, viable operations from day one.
All right, let's jump into Pillar 3, Priority Sector Lending Updates.
So where's the money actually going? The updated 2026 Priority Sector Lending, or PSL, framework brings some vital clarity by really tailoring targets to an institution's specific purpose. Commercial banks are sitting at a 40% target. Small finance banks are at 60%. And regional rural banks, they must dedicate a massive 75% of their lending to priority sectors, like agriculture and MSMEs. They've also tweaked the computation methodology to better align with large exposure frameworks, and they added a brand new provision. Bank loans to the National Cooperative Development Corporation for on-lending are now officially eligible as PSL. That is a huge boost for cooperatives across the country.
Now, this next point might seem like a small administrative detail, but it is an absolute game changer for financial inclusion at the grassroots level. Under the new 2026 directions, banks are strictly prohibited from levying any service charges on priority loans under 50,000 rupees. Think about a smallholder farmer or a micro-entrepreneur taking out a tiny loan. Eliminating these hidden fees ensures that the credit they desperately need is as affordable and impactful as possible.
Next up, Pillar 4, Protecting the Digital Consumer. We've all been there, right? Let's be totally honest. If you've ever felt completely lost trying to dispute a weird digital transaction, an unauthorized fee, or a glaring banking error, you know how incredibly frustrating it can be bouncing between 5 different customer service departments. The RBI clearly recognizes that as digitalization speeds up, consumer protection has to evolve at the exact same pace. So their next big move is specifically designed to solve this exact headache for you.
Enter the RBIOS 2026. Going live on July 1, 2026, this scheme is a massive upgrade. It completely replaces the older, somewhat fragmented 2021 framework and merges all the separate ombudsmen into one single, powerful, integrated platform. It doesn't matter if your issues with a commercial bank, a deposit-taking NBFC, a credit information company, or a non-bank payment issuer, you now have one non-adversarial, time-bound mechanism to get it sorted out. And heavily emphasizes settling things through conciliation, and actually gives the RBI expanded powers to award compensation when things go wrong.
Finally, we arrive at Pillar 5, Relief and State Finances.
When a natural disaster strikes, the absolute last thing a community needs is financial punishment layered on top of physical devastation. The RBI's new draft guidelines introduce a brilliantly compassionate yet very pragmatic resolution framework. First off, regulated entities have to immediately establish alternate banking arrangements in the disaster zone. Then, they actively design resolution plans just to give borrowers some much-needed breathing room. But here is the crucial part. These restructured loans actually retain their standard classification. This means a borrower's credit standing isn't destroyed by an act of nature, while lenders can continue to recognize income on an accrual basis with much lower provisioning requirements. It's a win-win in a terrible situation.
So, there you have it. The RBI's January 2026 Masterclass reveals a central bank that is aggressively, almost methodically, future-proofing its economy. From taming wild forex volatility and capping bank dividends, all the way to empowering everyday digital consumers and providing intelligent disaster relief, they are meticulously constructing a resilient financial fortress. But I want to leave you with this final thought to ponder.
As global debt keeps rising and our financial interconnectedness deepens by the day, how exactly will these newly reinforced pillars hold up when the next unpredictable global financial shockwave inevitably hits? Thank you so much for joining us for this explainer, and definitely keep a close eye on how these fascinating policies continue to unfold.